You know what? There's simply no way to sugarcoat the first half of this year. It's been pretty tough for almost everybody, and weeks like last week, it really tests the resolve of even the most disciplined investors. Now that we're officially in bear market territory, what we're asking is, what should we do next? Now, I want to kind of look back in history for some perspective. And we're going to look at a conservative allocation portfolio, 90% in bonds and 10% in stocks over the past 26 years. Now, when we do that, the average drawdown is about 0.87%. But since November of 2021, this conservative portfolio, it's down almost 13%. That's 15 times larger than the average during a period that captured 3 of the worst recessions in the history of the United States of America. Now, what if we look at a moderate portfolio allocation of 40% bonds and 60% stocks? Well, here the average drawdown over the past 26 years is just 4%, while the recent drawdown is over 4 times larger at 17%. Now, here's the thing that's painful, but by no means the worst we've encountered. All right, let's move to aggressive. If we look at an aggressive allocation of 10% in bonds and 90% stocks, the average drawdown is around 8.5% over the past 26 years, while the current drawdown is more than twice as large at 19%. Again, no doubt that this has been painful, but not the worst ever. In fact, if we go back to 2001 and 2008, those recessions were materially worse than what's happened since November. Now, I've got a couple of observations, and I think they're worth kind of discussing. First, conservative investors right now are feeling pain unlike they've ever experienced before. Being down this much in just 6 months is not only rare, it hasn't happened in over 4 decades. So it's definitely strange. Second, diversification is meant to smooth out the ride over time. Since so many conservative investments like treasury bonds and high-grade corporate bonds or debt have been pummeled over the past number of months, quite frankly, there has been nowhere to hide for disciplined investors who are either taking a longer-term view or a more conservative view using those instruments. Now, third, and I think this is probably most important, every historical downturn has not only been temporary, but also has been the foundation for a new phase of growth higher. In fact, despite an average intra-year decline of 14%, annual total returns were positive 35 of the last 42 years. And the years that endured a 10% or greater drawdown, they still delivered a positive total return of 75% of the time. And just over half of the years that had a drawdown of 15% or more also delivered positive total returns. So what's another way to say this? Well, most drawdowns, they've been short-lived, and not a single drawdown, not one, irrespective of risk tolerance, inflicted permanent damage to a properly diversified strategy. Now, it's unlikely that this time will be any different. There's really not a way, as I've mentioned before, that we can sugarcoat the first part of this year. We know it's been tough for everyone, and even those sitting in cash, it's not been a picnic. Based upon the headline rate of inflation right now, $1 million in cash is losing $86,000 annually to inflation. And those who spend more on maybe gas or airfare or hotels or buying a used car, they're getting hit even harder. Now, some might argue, hey, I'll take a guaranteed loss of 8.6% in cash rather than take a greater risk of loss elsewhere. But I got to tell you, I don't think it's that simple. Let's imagine that you timed the downturn perfectly and you moved to cash at the end of last year. Now, unless you began investing within the past year or two, you're probably still up over the last decade. If so, then your taxable accounts, they're subject to capital gains. Furthermore, you need to know when to get back into the market, or else you've got this thing called cash drag. And that cash drag could become a real anchor to future returns. So, all in all, running to cash does little more than trade market risk for execution risk, unless you have a specific strategy when to get back in the market. The thing is, paper losses, they come and go, but realized mistakes can become permanent. Now, another option would have been to make a tactical move away from diversified strategies into a highly concentrated strategy. For example, the what's called the Energy Select Sector Exchange Traded Fund, ticker symbol is XLE. It's up 50% so far this year. Now, let's imagine an investor looked into their crystal ball and built a portfolio consisting of 30% XLE and then 70% in the S&P 500 ETF. Well, they'd be flat today. But extreme moves like these, they also carry tremendous risk. It's so much so that any reputable compliance department wouldn't permit something like this for a conservative or moderate investor to go into an all-equity portfolio that heavily weighted in one sector. Even aggressive investors would be betting big on a highly volatile sector that had done, quite frankly, nothing in aggregate over the last 2 decades. The problem is, we're always going to deal with the would have, could have rhetoric, and that doesn't change the fact that we're here. We're in a bear market, and all of us are waking up every morning saying, is today the day that the pain's going to subside and things begin to turn around? So, what to do? What if we are in cash or we're timing the markets? Obviously those aren't optimal choices. So right about now, a braver man than I might utter 3 words that no investor wants to hear. Now I'm going to keep my mouth shut because the term stay the course is often so misinterpreted that it can do more harm than good. I think in the olden days, it meant sticking to a strategy as long as it remained capable of reaching the goal. It championed the dismissal of factors that were either temporary or just noisy and demanded the discipline to continually test assumptions and adjust to real economic change and real economic data. But here's the thing, somehow this is mutated into bury your head in the sand and do nothing, which could be the worst possible advice to give any investor. Economies and financial markets, they are constantly changing. So any strategy predicated on the notion of set it and forget it, like it's a rotisserie chicken or a rotisserie oven sold by Ron Popeil, this is just as risky, if not more risky, than day trading through volatility. So what's our plan? Well, here's the thing. This isn't the first bear market we've experienced, and it's not going to be the last one either. The course we plan to stay on is one that is deeply rooted in fundamental analysis and adapting to all phases of the economic cycle, both good and bad. Now, in doing so, we're going to continue to make incremental changes to our investments to manage the risk over the long run. And what that helps us do is avoid the temptation to react or overreact to the fear and panic dominating the day-to-day news cycle. Now, we also plan to keep building financial plans consisting of more than just a stock and bond portfolio. We've got to look at tools like insurance, guaranteed income, cash flow analysis, and then also stress testing these plans that, what we use has over 50,000 plus simulations, all of these working together to keep our investors on course. That way, the financial plan can take a hit and keep going because it isn't relying on a singular tool or strategy. So the bottom line, well, it's that staying the course only makes sense when the course is first built to evolve over time, and 2, capable of taking you to your financial goals, which is what we're committed to doing. If you have questions or you want to discuss your financial plan in greater detail to make sure that you are still in the right path for your goals, give us a call. If you are one of our clients, we always welcome the opportunity to review everything with you. And if you're not a client, we always like the opportunity to see where you are and give you good, sound, solid advice for what's best for you.